Hey there, and welcome to Blockchain 101, your 1-hour crash course on one of the most talked about technologies of the 21st century. Whether you're here out of curiosity, for work, or because you've heard everyone from your barber to your banker mention blockchain, you're in the right place. No technical background is needed, just bring your passion for learning and a bit of curiosity. So, let's start with the big question: what exactly is blockchain? At its simplest, blockchain is a digital system for recording information in a way that makes it very hard, nearly impossible, to change or hack. You can think of it like a digital ledger, like an Excel spreadsheet or a Google Doc, except it's not stored in one place, and no single person controls it. Instead, it's shared across a network of computers, all of which hold the same copy of the data. Now imagine this: every time someone writes a new line in that spreadsheet, like recording a transaction, that line is automatically duplicated to every copy around the world. If anyone tries to tamper with their version, the others reject it. That's the magic of blockchain. It's decentralized, transparent, and secure by design. Let's compare it to how we currently do things. In most systems today, banks, companies, and even governments, information is stored in central databases. These are controlled by a single authority. If someone hacks it or if there's a mistake, things can go really wrong. With blockchain, there's no single point of failure, and no one person or entity is in charge. It's more like a group project where everyone has to agree before anything can be changed. The first time blockchain went mainstream was with the invention of Bitcoin in 2009. Bitcoin uses blockchain to record digital transactions, basically money, in a decentralized way. For the first time ever, two people could send money to each other over the internet without needing a bank or a payment app like PayPal in the middle. And it worked. Bitcoin proved that you could trust the system, not the people in it. But here's the important part: blockchain is not just for money. That's just one application. Think of blockchain as a new way to build systems. It can be used anywhere, and trust and transparency matter. Let's look at some examples. In supply chains, companies are using blockchain to track the journey of products, from the factory to the store shelf. It helps prevent fraud, confirms authenticity, and gives buyers confidence. In healthcare, blockchain can store medical records securely and give patients control over who sees their data. In voting, it can ensure every vote is counted and can't be changed, making elections more transparent. Now, I know what you might be thinking. Okay, sounds cool, but what makes blockchain so special? 3 things. First, decentralization. Traditional systems have one central authority. Blockchain spreads control across many participants. This makes it much harder to manipulate or corrupt. Second, immutability. Once something is recorded on a blockchain, it can't be changed. That makes the record permanent and tamper-proof. And third, transparency. Depending on the type of blockchain, anyone can view the data. That's powerful. It means you don't have to blindly trust someone's word, you can verify it yourself. Let's go back to that notebook analogy. Imagine that every page in the notebook is a block. Each block has a bunch of data, say, transactions. Once a block is full, it's closed and linked to the previous block, forming a chain. That link is created using something called cryptographic hashing, a fancy way of saying it's locked in a way that's very hard to break. And here's the kicker: every block has a unique fingerprint, and that fingerprint depends on the data inside it. Change the data, and the fingerprint changes too. Which breaks the link? Which alerts everyone? So tampering with the data? Not so easy. Now, not all blockchains are the same. Some are public, like Bitcoin or Ethereum, where anyone can join and participate. Others are private, used by businesses or governments, where access is restricted. However, the core principles remain the same: shared data, consensus, and security. If this is starting to feel like a lot, that's totally normal. Blockchain can feel overwhelming at first, especially with all the jargon out there: tokens, wallets, mining, smart contracts, DeFi, and NFTs. But don't worry, we're going to break all of that down in the next sections, step by step. For now, just remember this: blockchain is about creating a shared truth. It's a way to record and verify information across a network without needing to blindly trust any single participant. That's a big shift. It challenges old systems and opens the door to new ones, more open, more fair, and more secure. The goal here is to understand not just what blockchain is, but how it actually functions behind the scenes. Let's start with the word itself, blockchain. 2 words. First, blocks. Second, chain. Simple enough, right? So, what's inside a block? Think of a block as a digital container. Inside it, you'll usually find 3 things. First, a list of recent transactions, kind of like a receipt of things that just happened. Second, a timestamp marks when the block was created. Third, there is a special code called a hash, which is like the block's unique fingerprint. Now, this fingerprint isn't random. It's generated based on the block's contents. Even the tiniest change, like swapping a single letter, will totally change the fingerprint. That's important because it's how the system knows if someone has tampered with the data. So, what happens when a block is full? It gets sealed and linked to the previous block by storing that previous block's hash. And the next block? It does the same. Over time, this creates a linked list of blocks, a literal chain of blocks. That's the blockchain. Now here's where it gets interesting. Because every block stores the fingerprint of the block before it, you can't mess with one without breaking the chain. Change one block and all the others after it becomes invalid. This is a huge part of what makes blockchain secure. The data is locked in with cryptographic links. Alright, let's talk about decentralization, which is a key reason blockchain is such a big deal. In traditional systems, data lives in a central place, like a company's server or a government database. That makes it vulnerable. If someone hacks that one place, game over. However, in blockchain, there isn't a single database or central server. Alternately, the blockchain is stored on a distributed network of computers, which are referred to as nodes, located all over the world. Every node possesses a complete copy of the blockchain. They constantly talk to each other, and they have to agree on what the current state of the blockchain is. This is called consensus. If someone tries to add a fake transaction, the rest of the network will reject it. Why? Because it doesn't match what the other nodes have. It's like trying to forge a page in a book that everyone else has already read and memorized. This decentralized nature makes blockchains incredibly resilient. If one node goes offline, the network keeps running. If someone tries to attack it, they'd need to control a majority of the network, which, depending on the blockchain, is nearly impossible. So how do these nodes actually agree on things? That's where consensus mechanisms come in. You've probably heard of terms like proof of work or proof of stake. These are methods that nodes use to agree on which block gets added next. In Bitcoin's proof of work protocol, computers compete with one another to find a solution to a very challenging mathematical issue. The first person to solve it will be rewarded with the ability to add the next brick to the puzzle. This process is called mining, and it uses a lot of electricity, which is why it gets criticized for being energy hungry. Then there's proof of stake, which Ethereum and other blockchains are moving toward. Instead of using computing power, it chooses who gets to create the next block based on how much cryptocurrency they're holding or staking. It's way more energy efficient. There are other consensus models too, like delegated proof of stake, proof of authority, and more, but the key idea is the same. The network has a way of agreeing on what's valid and what's not, without needing a central authority. Now let's talk about public versus private blockchains. A public blockchain is open to everyone. Anyone can join, read data, write data, if they follow the rules, and help maintain the network. Bitcoin and Ethereum are public blockchains. They're permissionless, transparent, and resistant to censorship. A private blockchain, on the other hand, is restricted. It's usually used by companies or organizations that want the benefits of blockchain, like immutability and transparency, but within a controlled group. Access is limited, and only approved participants can view or write data. Additionally, there is a type of blockchain known as a consortium blockchain, which functions similarly to a private blockchain but is really managed by a collection of organizations rather than just one. This is common in industries where multiple parties need to collaborate, like in finance or logistics. All of this brings us to an important point: blockchains are not one size fits all. The way they're built depends on what they're being used for. A cryptocurrency like Bitcoin needs to be totally decentralized and trustless. A company tracking shipments might prioritize speed and privacy instead. So, to recap what we've covered so far, A block stores data, a timestamp, and a cryptographic hash. Each block links to the one before it, forming a chain. Blockchains are stored across many computers, called nodes. Nodes use consensus mechanisms to agree on the state of the blockchain. There are public, private, and consortium blockchains, each with its own use case. Now, let's add one more important term to your vocabulary: immutability. The term immutability refers to the fact that nothing can be altered or removed from the blockchain after it has been recorded there. This creates a permanent, auditable record of events. And that's huge. Think about accounting, medical records, and legal documents. All of these depend on accurate, untouchable records. Blockchain offers that by default. It also creates something called trustless trust, which sounds weird but makes total sense. In traditional systems, we trust people or institutions. With blockchain, we trust the math, the code, and the network's consensus. That's a totally new way to think about trust. It doesn't mean bad things can't happen, but it does mean that when they do, the records are there for everyone to see. There's no rewriting history. And finally, a word on scalability. Early blockchains like Bitcoin and Ethereum were revolutionary but slow. As more people started using them, they struggled to keep up. That's why there's a huge push now for scalability through things like Layer 2 networks, sidechains, and sharding. We'll dive deeper into those topics later, but for now, just know that the core challenge is this: how do we keep blockchains decentralized and secure while also making them fast enough for the real world? Alright, that's a solid foundation. You now understand how blockchains store data, how they stay secure, how participants agree on the truth, and the different types of networks that exist. Let's imagine you want to send some digital currency, like Bitcoin, to a friend. What actually happens behind the scenes? It all starts with a transaction. You tell the network, hey, I want to send 0.1 Bitcoin to my friend. That transaction includes a few key details: your digital signature, proving it's really you, the recipient's address, the amount, and a timestamp. This transaction gets broadcast to the blockchain network, where it waits in a kind of public queue, called the mempool. Think of it like a waiting room full of pending transactions. Now, someone needs to take that transaction and add it to the blockchain. That's where miners or validators come in. These are the participants who help keep the network running. Their job is to collect transactions, group them into a block, and then try to get that block added to the chain. If it's a blockchain like Bitcoin, it uses proof of work. Here's what that means: miners race against each other to solve a really tough math puzzle. It takes a lot of computing power, and the first miner to solve it earns the right to add the new block, plus a reward, like some fresh Bitcoin. Why the puzzle? Because it creates a cost. It ensures that adding a block requires effort, which makes tampering expensive and difficult. You'd have to outwork the rest of the network to fake anything, and that's nearly impossible. If it's a proof-of-stake system, like Ethereum 2.0, things work differently. Instead of using computing power, validators are chosen to create blocks based on how much cryptocurrency they've locked up or staked. It's like putting skin in the game. If they try to cheat, they lose their stake. So they're financially motivated to play fair. Once a block is created, the network needs to agree that it's valid. That means checking every transaction. Is the sender's signature real? Do they have enough funds? Is the format correct? If everything checks out, the block is accepted, linked to the previous block, and becomes part of the permanent blockchain record. At that point, your transaction is confirmed. It's now part of the blockchain, visible to everyone, unchangeable, and timestamped forever. Now, here's something really cool: everyone can verify that transaction themselves. You don't need to trust a bank or a company. The transaction data is public, and you can check it using any blockchain explorer. This is what people mean when they say blockchain is transparent. Let's take a quick look at the steps again. You create a transaction and sign it with your private key. The transaction is broadcast to the network. It waits in the mempool for a miner or validator to pick it up. The miner solves a problem, or a validator is chosen to create a new block. The block is verified by the network and added to the chain. Your transaction is confirmed, and it's there forever. But wait, what stops someone from sending the same money to two people at once? That's called double spending, and blockchain solves it using that same consensus process. If you try to trick the system by sending the same coin to two places, only one transaction will be confirmed. The rest of the network will reject the duplicate. Why? Because the digital ledger only recognizes what's been confirmed in a valid block. Once something is confirmed and added to the chain, it becomes part of history. That's what makes blockchain such a breakthrough. It lets people agree on a shared version of the truth without needing to trust each other. It's all handled by math, code, and a decentralized network of computers. Now let's talk a bit about fees. In many blockchains, you pay a small fee to have your transaction processed. This fee goes to the miner or validator who includes your transaction in the block. The higher the fee, the faster your transaction usually gets confirmed. It's like tipping a waiter. It doesn't change the meal, but it might get you faster service. And here's another thing you might have heard. Sometimes blockchain transactions are slow or expensive. That's true, especially during peak demand. That's why a lot of innovation right now is focused on scaling solutions, new ways to make blockchain faster and cheaper without compromising its core features. These include things like Layer 2 solutions, which process transactions off-chain and only settle the final result on the blockchain. Sidechains, which are separate blockchains connected to the main one. Sharding, which splits the network into smaller parts to process data in parallel. We'll touch on those more later, but just know that blockchains are evolving fast, and there's a lot of work being done to make them more practical for everyday use. Before we move on, let's zoom out and ask, what really makes blockchain special? It's not just that it records transactions. We've had databases for decades. What makes blockchain powerful is that it combines transparency, security, and decentralization into one system and does it in a way that's verifiable by anyone. Every transaction is digitally signed, so it can't be faked. Timestamped, so there's proof of when it happened. Verified by the network, not a single authority. Locked in permanently, so it can't be changed later. That's why blockchain is being called the foundation for Web 3, a new internet that's not owned by a few big players but run by users themselves. And it all comes back to these simple steps: broadcast, verify, add to a block, and link to the chain. Whether it's moving digital money, recording supply chain data, or proving ownership of a digital asset, that process remains the same. So, that's how blockchain works under the hood. The next time you hear someone talk about sending crypto or confirming a transaction, you'll know exactly what's happening behind the scenes. But what if I told you blockchain isn't just for moving money or recording data? What if you could actually program logic, like rules, conditions, and actions, directly into the blockchain itself? That's where smart contracts come in. Let's start with the name. Smart contract sounds futuristic, but it's actually a pretty simple idea. A smart contract is just a piece of code stored and run on a blockchain. It defines a set of rules. If this happens, then do that. And once it's deployed, it executes automatically when those rules are met. No middleman, no delays, no interpretation. It's like setting up a digital vending machine. You insert the right amount of crypto, and the machine checks the amount and gives you your product. No human involvement. If the amount isn't right, it doesn't work. Simple logic, but automated and trustless. Now, these smart contracts aren't smart in the way AI is smart. They don't learn, adapt, or think. And they're not contracts in the legal sense either. They're closer to scripts, lines of code that enforce agreements without needing a third party to mediate or enforce them. So why do smart contracts matter? Because they allow people to automate trust. Instead of relying on people or institutions to follow through on agreements, we can write those agreements in code and let the blockchain enforce them. Let's look at a few real-world examples. Say you're crowdfunding a project. You want to raise money from a bunch of supporters, but you don't want to take their money unless you hit your goal. A smart contract can hold the funds in escrow. If the funding goal is reached by a certain deadline, the contract automatically releases the money to you. If not, everyone gets a refund. No need for a platform like Kickstarter to be in the middle. Or imagine renting out an apartment. A smart contract could be programmed to unlock a smart lock when the tenant pays their rent in crypto. As long as the payment goes through, access is granted. If the payment stops, access is revoked. The entire agreement is automated. Smart contracts are most commonly used on Ethereum, the second largest blockchain after Bitcoin. In fact, Ethereum was built from the ground up to support smart contracts. Unlike Bitcoin, which is mainly for payments, Ethereum is like a global computer. You can run code on it, and that code is stored forever across thousands of nodes. Developers write smart contracts in a language called Solidity, which looks a bit like JavaScript. Once written, the contract is deployed to the Ethereum blockchain, where it gets a unique address. From there, anyone can interact with it by sending data or cryptocurrency, and the contract will do what it's programmed to do. Now here's where things get really powerful. Smart contracts can interact with other smart contracts. They can call functions, share data, and build on each other. This creates a whole ecosystem of decentralized apps, or DApps, that work together like building blocks. Think of it like Lego for the internet. This is the foundation of something called DeFi, or decentralized finance. In DeFi, you have apps that let you borrow, lend, trade, or earn interest on crypto, all without a bank. No account signup, no credit score, just your wallet and some smart contracts. For example, you can deposit your crypto into a smart contract and instantly start earning interest. Someone else can borrow that crypto by putting up collateral. The entire process, from deposits to loans to interest calculations, is handled by code. And because everything is on the blockchain, it's all transparent. You can audit the code. You can see the transaction history. You don't have to trust anyone, just the logic. Another space smart contracts have exploded in? NFTs, non-fungible tokens. NFTs are digital assets, like art or collectibles, that are tracked and owned via smart contracts. When someone mints an NFT, a smart contract records the creator, the owner, the royalties, and more. Every time the NFT is sold or transferred, the smart contract updates the ledger and can even send automatic royalties to the original artist. So, smart contracts allow for automation. Actions happen without needing a person to push a button. Trustlessness, no need to trust the other party, the code handles it. Transparency, anyone can verify how the contract works. Efficiency, no delays, no intermediaries, no paperwork. Global access, anyone with a crypto wallet can interact with them. But, as with anything powerful, there are risks too. The biggest one? Bugs in the code. A smart contract, once deployed, usually can't be changed. If there's a mistake, it can be exploited, and that's happened multiple times. Millions of dollars have been lost because of loopholes in contracts that attackers took advantage of. That's why smart contract audits are a huge deal. Before launching, many projects hire security experts to review their code line by line, testing for vulnerabilities. There's also the issue of complexity. Writing smart contracts well requires deep knowledge of both programming and blockchain behavior. You're not just building a website, you're writing code that, once launched, controls real value in an irreversible environment. And then there's scalability. Every interaction with a smart contract requires gas, a kind of transaction fee paid to the network. When the network is congested, gas prices go up. That can make interacting with smart contracts expensive, especially for smaller users. That said, the space is rapidly evolving. We now have Layer 2 solutions, like Arbitrum, Optimism, and ZK rollups, that make smart contract interactions faster and cheaper by offloading work from the main Ethereum chain. Other blockchains like Solana, Avalanche, and Polygon also support smart contracts, each with their own speed, cost, and trade-offs. Some prioritize throughput, others security, and others developer friendliness. So, the ecosystem is expanding fast, and smart contracts are at the heart of it. They're not just powering finance, but also gaming, identity, insurance, logistics, social media, and more. Any system that relies on rules, trust, or coordination between people could, in theory, be automated with smart contracts. Let's bring it back to a simple takeaway. A smart contract is a program that lives on a blockchain. It runs exactly as coded, no matter what. Once it's out there, it can't be stopped, changed, or manipulated. That makes it incredibly powerful, and also something you have to build carefully. If the internet gave us websites and apps, smart contracts would give us decentralized applications, DApps, that no one owns and that no one can shut down. Apps that live everywhere and nowhere at once. So whether it's buying art, taking a loan, voting in a DAO, or joining a game, chances are a smart contract is involved. And that's the beauty of it. Code becomes law, and that law runs 24/7 for anyone, anywhere. Now it's time to talk about something you've definitely heard of: cryptocurrencies and tokens. Let's start with the basics. A cryptocurrency is a digital form of money that lives on a blockchain. The first and most famous example is Bitcoin, which was launched in 2009. Bitcoin was created as a peer-to-peer currency, meaning you could send it to anyone, anywhere, without needing a bank, a government, or any third party. Bitcoin kicked off the entire blockchain movement. But it's far from the only cryptocurrency out there. So what actually makes something a cryptocurrency? There are a few key traits. It's digital, you can't touch it or hold it. It's decentralized, no single person or group controls it. It's secured by cryptography, hence the name crypto. It's verifiable and limited, you can check the supply and track every transaction. Bitcoin does all of that. In addition to having a predetermined amount of 21 million coins, it operates on its own blockchain. Blocks are used to record transactions after they have been validated by miners. The rules are baked into the code, and they can't be changed without network-wide consensus. But Bitcoin is just one flavor of crypto. Since then, thousands of other cryptocurrencies have launched, each with its own purpose, rules, and ecosystems. Take Ethereum, for example. While Bitcoin focuses on being digital gold or money, Ethereum is more like a global computer. It's the leading platform for smart contracts and decentralized apps. Ether, ETH, is the native cryptocurrency that powers it, which is used to pay for transactions and run apps. Beyond those two, we have other Layer 1 cryptocurrencies, meaning they have their own blockchains. Examples include Solana, Avalanche, Cardano, Polkadot, and BNB Chain. Each has its own design, speed, fees, and community, and they all aim to solve different problems. Now, let's break down a word that gets used a lot in crypto: token. What's the difference between a coin and a token? A coin usually refers to a cryptocurrency that runs on its own blockchain, like BTC on Bitcoin or ETH on Ethereum. A token, on the other hand, is built on top of another blockchain, usually Ethereum. It doesn't have its own chain, it borrows the infrastructure of an existing one. Think of it like this: Ethereum is the operating system. Tokens are the apps. Anyone can create a token using Ethereum's smart contract standards, and there are thousands of them. The most common standard is called ERC20, and it's used for fungible tokens. Fungible just means each unit is identical and interchangeable. Think of dollars or coins. Examples of ERC20 tokens include USDT, Tether, a stablecoin pegged to the US dollar. Uniswap, a governance token for the Uniswap platform. Link, Chainlink, a utility token for decentralized data feeds. Then there's the ERC721 standard, used for non-fungible tokens, or NFTs. Unlike ERC20 tokens, each NFT is unique. That makes them perfect for digital art, collectibles, in-game items, and more. So tokens can represent almost anything. Money or value. Governance rights. Access to services. Ownership of assets. Rewards or incentives. And because tokens live on the blockchain, they can be traded, programmed, and moved instantly, with no borders and no intermediaries. One powerful category of tokens is stablecoins. These are cryptocurrencies that are pegged to something stable, usually a fiat currency like the US dollar. Examples include USDT, Tether, USDC, USD Coin, DAI, a decentralized stablecoin. Stablecoins are popular because they give you the speed and flexibility of crypto without the price volatility. They're used for trading, saving, payments, and even earning yield in DeFi. Another big category is governance tokens. These give holders the power to vote on how a platform or protocol operates. It's like owning a piece of a decentralized organization. As your token count increases, so does the amount of influence you have. DAOs, which stand for Decentralized Autonomous Organizations, operate in this manner. So instead of a CEO or a board making all the decisions, token holders collectively decide how the system should evolve. It's a new form of community-driven governance. Now, let's talk wallets. If cryptocurrencies and tokens are digital money, you need a place to store them. That's where crypto wallets come in. A wallet is basically software that lets you manage your crypto, send, receive, store, and interact with dApps. Every wallet has a public address, like your bank account number. A private key, like your PIN or password. Your private key should never be shared. Your funds are accessible to anyone who possesses that key. Take into consideration that it is the key to your digital safe. There are two main types of wallets. Custodial wallets. These are provided by exchanges like Coinbase or Binance. They manage your private keys for you, just like a bank. Easier to use, but you give up some control. Non-custodial wallets, like MetaMask or Trust Wallet. You control your keys, which means you control your crypto. More responsibility, but also more freedom. With a wallet, you can do a lot more than just store tokens. You can interact directly with smart contracts, vote in DAOs, mint NFTs, and use DeFi protocols, all from your browser or phone. And then there are crypto exchanges, platforms where you can buy, sell, and trade cryptocurrencies. There are two types. Centralized exchanges, CEXs, like Binance, Coinbase, and Kraken. Easy to use, high liquidity, but you don't control your keys. Decentralized exchanges, DEXs, like Uniswap, SushiSwap, and PancakeSwap. You trade directly from your wallet using smart contracts. More control, but also more responsibility. DEXs run entirely on smart contracts, with no company or middleman. They're a core part of DeFi, and they wouldn't exist without tokens. Let's talk real for a second. Crypto is exciting, but it's also risky. Prices are volatile, scams exist, and not every token has real value or utility. So don't just chase hype. Always ask, what problem does this token solve? Does it have a working product or just an idea? Who's behind it? Is the code public and audited? Is the supply fixed or unlimited? Education is your best defense in this space. Don't invest in anything you don't understand, and never risk more than you can afford to lose. But when used wisely, cryptocurrencies and tokens unlock a whole new way to think about value, ownership, and participation. They make the internet more than just a place to consume. They make it a place where you can own, contribute, and build. Let's recap. Cryptocurrencies like Bitcoin and Ethereum are digital assets that run on their own blockchains. Tokens are assets built on top of existing blockchains, mostly Ethereum. Tokens can be used for payments, governance, rewards, access, and more. Wallets let you manage your crypto, and exchanges let you trade it. The ecosystem is growing fast, but so is the need for caution, clarity, and informed decision-making. By now, it's clear that blockchain is way more than just crypto. Coins and tokens might have been the first killer app, but the technology underneath. It has massive potential across dozens of industries. We're zooming out to explore how blockchain is being used beyond cryptocurrency in the real world, solving real problems. Let's kick it off with a big one: supply chain management. Think about how products move around the world. A single item, say, a bag of coffee, might be grown in Colombia, processed in Germany, packaged in China, and sold in New York. Dozens of companies touch it. Traditionally, tracking all that movement relies on paperwork, siloed databases, and a lot of manual effort. That creates problems, delays, fraud, missing records, fake goods, and zero transparency for the end buyer. Now imagine that every step in that product's journey was recorded on a blockchain. Each participant adds a timestamped record, harvest date, shipment, customs clearance, warehouse scan, and final delivery, all visible on a shared ledger. No one can alter the history. Everyone sees the same truth. That's exactly what companies like IBM, Walmart, and Maersk are doing, using blockchain to improve tracking, prevent fraud, and build trust between suppliers and customers. You could scan a QR code on a mango and see exactly where it came from, when it was picked, and how it traveled. That's traceability made simple and secure. Next up, healthcare. Medical data is sensitive, messy, and often scattered across systems. If you've ever switched doctors or gone to a specialist, you know how painful it is to get your records transferred. And let's not even talk about data breaches. Blockchain offers a new model: patient-owned, portable, and secure health records. Instead of having your data locked inside hospital databases, you could store it on a blockchain, or better yet, store the data off-chain and use the blockchain for secure access control. Only the people you authorize can view it. And every access is logged transparently. This means faster care, fewer mistakes, better privacy, and a healthcare system that actually works for the patient, not just the provider. And it's not science fiction. There are startups right now building blockchain-based medical ID systems, vaccine passports, and clinical trial trackers. Let's talk about another major use case: identity. Right now, your identity is tied to usernames and passwords scattered across hundreds of sites. Your real identity, managed by governments and corporations. You don't really own it, you rent access to it. Blockchain flips that model. It enables self-sovereign identity, a fancy way of saying you control your identity and you decide who can access it. Using digital wallets and verifiable credentials, you could prove your age, citizenship, education, or employment without revealing everything about yourself. No more handing over your full ID just to get into a bar or verify your email. Even better, once verified by a trusted source, like a university or government, your credentials can be cryptographically signed and stored in your digital wallet. Anyone else can verify them instantly without calling the issuer. It's privacy first, fraud resistant, and portable, a digital passport for the internet age. And then there's voting. Every election cycle, we hear the same concerns: voter fraud, hacking, long lines, and mail-in ballot delays. Blockchain can help. With blockchain voting, every vote can be recorded on a transparent, tamper-proof ledger. Voters could cast their ballot from a smartphone with strong encryption and identity verification. Each vote would be timestamped, publicly visible, but anonymous and impossible to alter. People could verify that their vote was counted without knowing who they voted for, and anyone could audit the results. Now, is it perfect? No. There are real challenges: accessibility, device security, and adoption. However, pilot projects are already underway in places like Utah, Estonia, and South Korea. The tech is moving fast. Let's pivot to something more creative: digital art and ownership. If you've heard of NFTs, you already know the basics. NFTs use blockchain to prove who owns a unique digital item, whether it's art, music, collectibles, or game assets. Before blockchain, digital files could be copied infinitely, and ownership was basically meaningless. Now, thanks to NFTs and smart contracts, artists can mint their work, sell it directly, and get royalties every time it resells. The blockchain proves who owns what, when it was created, and how it's changed hands. This is already disrupting the art world, the music industry, and even gaming, where players can truly own in-game assets that can be traded across platforms or even sold for real money. Speaking of games, blockchain is unlocking new models for gaming in virtual worlds. In traditional games, everything you earn or buy is locked in that game's ecosystem. If the company shuts it down, your progress disappears. But in blockchain games, your items, characters, and achievements live in your wallet, not the company's server. You can trade them, sell them, or use them in other games. This is the foundation of the metaverse: persistent, shared digital spaces where you actually own what you earn. Companies like Animoca Brands, Sky Mavis, and others are pioneering this space with games like Axie Infinity and The Sandbox. Next up, real estate and land registries. In many countries, proving your own land is shockingly hard. Paper documents can be lost, forged, or manipulated. Court cases over property disputes drag on for years. With blockchain, land titles can be digitized, timestamped, and made tamper-proof. Ownership changes can be logged permanently, reducing fraud and increasing trust, especially in places where corruption is common. Some governments, like in Sweden, Georgia, and India, are already testing blockchain for land records and property transactions. Then there's intellectual property, patents, trademarks, and copyrights. Blockchain can be used to record the creation of an idea, invention, or design, giving creators a digital timestamp that proves they were the first. Smart contracts can automate royalty payments and license tracking. No more fighting over who had the idea first. And in energy markets, blockchain is powering peer-to-peer trading. Imagine you have solar panels. You generate extra energy. Instead of selling it to a power company, you could sell it directly to your neighbor using a blockchain platform. The smart contract tracks how much power was shared and automatically pays you in tokens. Clean, transparent, and efficient. Let's not forget charity and donations. Blockchain can bring transparency to the nonprofit world. Donors can track where their money goes, how it's spent, and whether it reaches the intended cause. Every transaction is visible. No more wondering if your donation disappeared into admin fees or shady middlemen. Other real-world use cases include insurance, faster claims processing with smart contracts. Logistics, cross-border trade, customs, and shipping. Education, verified diplomas and certifications. Legal tech, automated contracts, dispute resolution. Agriculture, crop tracking, fair trade verification. So, what's the common thread in all these use cases? It's trust. Blockchain builds trust not by creating one central authority, but by removing the need for one in the first place. It replaces trust me with verify it yourself. And it works best in systems where there are multiple parties who don't fully trust each other. Data integrity and history really matter. Transparency improves outcomes. Middlemen slow things down or add cost. Fraud or corruption is a real risk. It's not about using blockchain for everything. It's about using it where it makes sense, where the old systems just don't cut it anymore. So no, blockchain isn't a silver bullet. It's not going to fix every problem overnight, but it is a tool, and when applied in the right way, it can radically improve how we share information, prove ownership, and coordinate as a society. Now we need to talk about the real challenges blockchain faces. Because while the tech is promising, there are some serious hurdles on the road to mass adoption. Let's start with one of the biggest ones, scalability. Right now, most blockchains are slow, at least compared to traditional systems. Bitcoin processes about 7 transactions per second. Ethereum does around 15 to 30. Compare that to Visa, which handles over 24,000 transactions per second. It's not even close. Why the bottleneck? Because every transaction needs to be verified by multiple nodes, added to a block, and stored forever. That makes the network secure and decentralized, but not fast. This is called the scalability trilemma: security, decentralization, and scalability. Pick two. Improving one often weakens the others. That's why there's so much work happening on layer 2 solutions, like rollups, channels, and sidechains, that take some of the load off the main blockchain. Ethereum's roadmap includes sharding, which splits the network into smaller parts that process in parallel. Other blockchains like Solana and Avalanche are experimenting with different architectures to boost speed without losing security. Next challenge, energy consumption. Proof-of-work blockchains, like Bitcoin, use massive amounts of electricity. Miners are essentially racing to solve math puzzles, which burns energy. Critics argue this is wasteful, especially in a world battling climate change. Bitcoin's defenders say mining often uses renewable energy and that securing a decentralized, censorship-resistant network is worth the cost. But it's still a valid concern. Ethereum addressed this in 2022 by switching to proof-of-stake, which cut its energy use by over 99%. Many newer chains, like Algorand and Tezos, use POS or eco-friendly alternatives from the start. So yes, energy use is an issue, but it's being tackled head-on. Next up, user experience. Let's be honest, crypto is still confusing. Wallets, gas fees, seed phrases, bridges, chains. For newcomers, it can feel like solving a puzzle just to send $5. That's a problem. If blockchain is going to reach billions of people, it needs to be invisible, like how most people use the internet every day without knowing how TCP/IP works. Better apps, simpler wallets, smoother onboarding, these are key to taking blockchain mainstream. The good news? We're seeing it happen. Apps are getting cleaner. Wallets are adding social logins. More Web 2.5 platforms are bridging the gap, giving users blockchain benefits without requiring them to understand the tech under the hood. Now let's talk about regulation. This one's tricky. Governments are still figuring out how to handle blockchain, especially crypto. Some countries, like El Salvador, are embracing it fully. Others, like China, have banned some of its aspects. Most are somewhere in the middle, cautiously watching, trying to balance innovation with consumer protection. There are real issues to regulate: scams, money laundering, and market manipulation. But heavy-handed rules could also push innovation away. The challenge is finding a middle ground where projects can innovate and grow, but users are protected and bad actors are kept in check. We've already seen legal battles over what counts as security, especially in the US, where the SEC has cracked down on some token sales and exchanges. That legal clarity, or lack of it, can slow progress, scare investors, and make building on blockchain feel risky. That said, more governments are launching central bank digital currencies, CBDCs, government-backed digital money that runs on blockchain-inspired tech. Countries like China, Nigeria, and the Bahamas already have pilot programs running. Others, like the US and EU, are exploring them. CBDCs might not be decentralized like Bitcoin, but they show that blockchain is influencing even the most traditional institutions. Another challenge? Interoperability. Right now, blockchains are kind of like islands, each with its own currency, community, and rules. Want to move tokens from Ethereum to Solana? You'll need a bridge, and many of those have been hacked or exploited. For blockchain to really scale, we need a multi-chain world where apps and assets move freely between networks, just like websites do on the internet. Projects like Polkadot, Cosmos, and Chainlink are working on this, building tools to connect blockchains and share data across ecosystems. This will be huge for the future. Now let's talk about security. Blockchains are secure in theory, but the stuff built on top of them? Not always. Smart contracts can have bugs. Protocols can be exploited. DeFi platforms have lost hundreds of millions of dollars to hackers. And once money's gone, there's no bank to call or password reset to hit. That's why audits, bug bounties, and open source code are so important. Users need to be cautious, and developers need to take security seriously. Education helps here, too, knowing how to spot red flags before clicking Connect Wallet on some sketchy site. Speaking of education, that's another major gap. Blockchain is a shift in how we think about money, ownership, identity, and trust. But most people haven't been taught this stuff. Schools don't teach it. Most media just throw around buzzwords. So if you've made it this far in the course, you're already ahead. Sharing what you've learned helps raise the bar for everyone and helps us all move forward smarter and safer. Alright, we've talked about the hard stuff. Let's end on a high note, the future. Where's blockchain going next? Here are some trends to keep your eye on. Mainstream adoption. More companies are integrating blockchain, not just crypto startups but big brands, banks, governments, and platforms. Real-world assets on chain, stocks, real estate, art, and music, it's all being tokenized. Blockchains will host not just native tokens but also digital versions of physical assets. DeFi 2.0, the next wave of decentralized finance, will be more user-friendly, more compliant, and more connected to traditional finance. Zero-knowledge tech, privacy tools like ZK proofs will let users prove things like age, income, or identity without revealing personal data. This could be huge for finance, healthcare, and beyond. Decentralized identity and reputation. Wallets will be more than just money holders. They'll carry your credentials, achievements, preferences, and trust score. Gaming in the metaverse. Blockchain is redefining digital worlds. Players will own their items, earn from gameplay, and move assets across games. Green blockchains, energy-efficient networks will continue to grow, making blockchain more sustainable and accessible. Institutional adoption. From JP Morgan to BlackRock, major players are entering the space, building, investing, and experimenting. Above all, blockchain will become boring. And that's a good thing. Because it means it's working. It means it's just part of life. We won't say blockchain app any more than we say internet website. It'll just be the default. It'll be in the background, securing your data, powering your payments, managing your identity without you having to think about it. So to wrap this up, blockchain is still early. The tools aren't perfect. The systems are evolving. But the shift has already begun. We're moving toward a world that's more open, more transparent, and more user-owned. A world where trust is built into the system, not bought with ads, intermediaries, or blind faith. That's what blockchain is really about. And you're now part of that story. Whether you go deeper, start building, or just share what you've learned, this technology isn't just for developers or investors. It's for everyone. Thanks for being here. Thanks for learning. And welcome to the future of trust. If curiosity has you overflowing with questions or you're seeking a little guidance, shoot us an email at hello@blockchaincouncil.org. We're here to light the way. For those hungry to expand their expertise, the Blockchain Council offers a gateway to mastering blockchain, AI, and Web3. Head to www.blockchain-council.org to discover our dynamic certification programs, enroll in a course that sparks your interest, and embark on your learning journey into tomorrow's innovations right away.